Hi, everyone. This is Marie with MRW. We're just going to give everybody a few more minutes to jump on, and then we'll go ahead and get started. Looks like a few more people are logging on, so we'll give it one more minute or so, and then we'll go ahead and start the presentation. All right, everyone, I think we're going to go ahead and get started. This is Marie Colbert with MRW. Pacific Life is a great partner of ours. They're extremely innovative and a market leader. They focus on accelerated underwriting program, which I know Carlan will speak to, but they have a competitive advantage there. Will go older than most other carriers. They've got a return of premium feature at no extra cost. Also have low minimum face amounts, which can be extremely advantageous if you have clients in that space, and competitive substandard ratings. So when most carriers are 25% per table, they're at 20%. So if you line up a table 2 to a table 2, Pac Life is generally going to be less expensive. And as everyone knows, the strong brand recognition and financial ratings of Pacific Life are hard to beat. So with that, I will go ahead and introduce Carlan Snipes, who's the Field Vice President for Pacific Life, and I will let her take it away.
Thank you, Marie. Thank you, guys and gals, for joining us today to learn more about Pacific Life and our PL Promise Term, as well as our GUL products and some of our underwriting niches. I really appreciate you taking time out of your busy day. So let's see if I can control the screen. Okay, there we go. So just want to talk a little bit about Pacific Life, and obviously it's a very highly recognized brand. It's a national scope from the East Coast to the West Coast. It's based in California, so it's very strong recognition obviously on the West Coast, but if you watch any college football or any sporting event, you'll see the whale jumping out of the water. So one cool thing about Pacific Life is consumers. It's highly recognizable with consumers, and we actually have a lot of consumers that actually call in direct because they want to have access to the product, so we refer them back to you guys to help out with that. The product line actually started in November of 2016. It was the old, if you're familiar with it at all, the old Colony Term product, which was actually owned by Genworth. And Pacific Life actually purchased that product from Genworth back in 2016 and started sales of the product line in November of 2016. The reason Pacific Life was interested in acquiring this product line was they really wanted to be more present in the brokerage side of the house. So they purchased the platform, they purchased the building in Lynchburg, Virginia, they purchased the Genius underwriting platform, as well as our drop ticket platform that we had at Genworth as well. So they're really interested in increasing their volume and being more in that middle market space where they're not today, well, they weren't previously. So when you think about Pacific Life, there's two different distribution models and there's two different product lines. The product line that I'll be talking about today is our death benefit protection product line, which is the term and the GUL. There is another product line that's done through an entirely different distribution out of California that's more focused on cash accumulation and more of an affluent sale, which is the IUL products as well as variable products. So it's two different distributions, two different contracts. One of the things that Pacific Life was really excited about with this acquisition was also the operational excellence that they were able to acquire, because the thing that Genworth did very well was high volume term business. I actually came from Genworth. I worked there for about 22 years. So in our heyday, we were processing about 6,000 applications a week. So we just very high volume, a lot of good business in that middle market space. If you did not know it, Pacific Life is a mutual company, and we have been around. This is actually our 151 years, so we've been around 151 years now. I was very excited to know that they were a mutual company. Having worked at a stock company I really appreciate the fact that a mutual company is focused on the policyholder, not the shareholder. So you don't have to worry from quarter to quarter that the company is going to change their plans around life insurance and what they're going to be doing. Mutual company like Pacific Life is very focused on the long term, so they're going to do what's in the best interest of that policyholder and stay focused on that. We were, again, voted in the top of world's most ethical companies for the second year in a row. We were voted that in 2017 and 2018, and that's across multiple industries. That's not just in the life insurance industry. Here's a look at our ratings. I will tell you, I don't get a lot of questions on our ratings. They're very strong. People are very comfortable with the company. The only thing that you do not see here is our Comdex, and our Comdex is 90. So with that, let's talk a little bit about the product series. So PL Promise Term is the product series that was the old Colony Term product. It's just been repriced and rebranded. And as Marie mentioned, we're extremely competitive across age ranges of 30 to 70. That's where we're going to be really focused, between 30 and 70. We do have that substandard advantage that Marie mentioned. So we changed our pricing a couple years ago on substandard because what we found was we were offering a competitive offer, but we were losing the case because our pricing wasn't as competitive as it needed to be at that substandard basis. So we're pretty competitive up to table 6. So you should be able to look at us up to table 6. And what we did was drop it from 25% of table to 20% of table on our substandard pricing. We do have a monthly modal factor advantage. We're going to be competitive. We're going to try to be in the top 3 to the top 5 with our pricing. But if we're not as competitive as you need us to be on an annual basis, make sure you always look at us on a monthly basis, because we're going to be extremely competitive on monthly modal factors. And the reason for that is simply the persistency is so good on the monthly policies, because people set those up as EFTs, and it's just a fabulous persistency rate, so we can pass on the benefits to the consumer with that. We do have a 25-year bucket with our term product series that is extremely competitive. You're going to see us be number 1 just about every single sale on that 25-year bucket. And it gives you a nice option. So if you're the client really needs the 30-year, but they're not willing to pay for the 30-year product, you can roll them back to the 25-year, not having to roll them all the way back to a 20, but you can roll them back to the 25-year a little bit less expensive. They still get a longer coverage period. We do have a very innovative conversion product. I'll talk about that in the next couple slides, so we'll save that for just a minute. We do have a select underwriting class, which gives you an advantage because another carrier, the client might qualify for standard. We can bump them up to select, which gives you and the client a pricing advantage if we can get them to select underwriting class. So it gives you a nice in-between preferred and standard option. And this product does go down, as Marie mentioned, lower face amount. So we do go down to $50,000 in face. That's our minimum face amount on this product. So the durations that are available with the PL Promise Term, you've got a 10-year option, a 15-year, 20, 25, and 30. Now, the riders that are built in, there's a terminal illness rider is built into the product. There's no charge for that rider. You can add a child term rider, or a waiver of premium rider to the product. Now, let's talk about conversions for a little bit. So conversion privilege allows the client to convert either the earlier of the end of the level term period or up to age 70. And let's take a look at that conversion product. So this conversion product came out a year ago, January. And what we wanted to do with this product is we wanted to learn from Genworth's mistakes in the past when it came to conversions and how horrible we experienced our mortality was, because what was happening was we'd priced the product in such a way that the only people that would choose to convert were the people that had no choice, right? They were uninsurable at this point, so they had to convert to keep the policy, and that was the only people that were converting. So what happened there at the end is our mortality was about 600% on our conversion product. So we wanted to come up with a conversion product with this one that didn't do that to the consumer. So we wanted to make it a win for the consumer, so it's going to be priced competitively. We wanted to make it a win for you as the producer on the policy, and we wanted to make it a win for the carriers to make sure that we were experiencing good mortality. So we did some different things with it, and I'll talk about that in just a minute, what that looks like. But it's a different approach, and what we're calling it is early, mid, and late term conversions. And with this approach, it allows us to give up to 150% of normal compensation to you as the agent on the case if you do an early term conversion. The other thing that we're doing that's a little bit different with this product is in the third policy year of every one of these that are sold, we're going to actively market to the consumer as well as you to help drive these early term conversions. So we're going to start, and that starts beginning of November this year, because the first policy will be in effect 3 years, November of 2019. So you'll get a look at what that's going to look like. But it's going to be a nice marketing campaign to help drive conversions. So the product itself, so what does the PL Promise conversion look like? It's a GUL product. It's a no-lapse guarantee design. You can dial it down to age 85 or take it out to 121. It does have competitive premiums. We wanted to make sure it wasn't priced out of the market. It is competitive against new sale products. The key here is if you've got a client that maybe could qualify for underwriting, but they just don't want to go through the hassle of underwriting, then they can go ahead and convert without having to go through underwriting again. Now, as Marie mentioned as well, it does have a return of premium feature that's built into the product, but I will tell you, general rule of thumb, you need to guarantee it to age 100 to get that return of premium feature built in. And the way this works is, let's say you have a client that converts, but they only need to keep the policy for 15 years, let's say. And at the end of the year 15, they choose to surrender it. The client can get up to 50% of their premiums back or 35% of the death benefit, whichever is the higher of those two numbers. If they keep it for 20 years and choose to surrender it at that point, they can get up to 75% of their premiums back or 35% of the death benefit. And lastly, if they keep it for 25 years and then choose to surrender it, they can get up to 100% of their premiums back or 35% of the death benefit, again, whichever is the higher of those two numbers. We do allow partial conversions with this product. You can do up to 2 partial conversions from PL Promise Term into the conversion product. It has to be at a minimum face amount of $50,000, but you can do up to two partial conversions. Now let's take a look at what I mean when I'm talking about this early, mid, and late concept. So this is a grid that's available actually in our product brochures for the conversion product, so you can get a better look at that in the guides. But let's look at a 10-year term product. Let's say you sold a 10-year term product to your client. And in year 4, you sat down with that client and had a conversation, and you both agreed it was time to convert that policy. So if the client converts in years 1 through 4 of a 10-year term product, it's considered an early term conversion, and we're going to pay you as the agent on the case 150% of your normal compensation. So whatever your current grid is, we're going to pay you 150% of that. Sorry, my other phone was ringing. Now, let's say you didn't talk to them and they weren't ready to convert. They waited. So they waited until year 8. So at that point, they decided to convert. Now, the key here is the premiums are going to be the same for the client, regardless if they do an early term conversion or a mid-term conversion, The only difference is they're going to be a little bit older. So they waited 4 more years to convert. So it's going to cost them a little bit more because they're 4 years older. But they convert in year 8. What's going to happen to you from a compensation standpoint, we're going to pay you 100% of your normal compensation. So whatever your normal grid is, that's what you're going to get on it. And the client's going to get our most competitive premiums. However, they're going to be 4 years older. Now, let's say they waited until year 10 to convert. So in year 10, that's considered a late term conversion on that 10-year product. We're actually going to cut your compensation 50%, and we're going to actually charge that client higher premiums to take that policy. And the reason for that is we're trying to discourage these late term conversions because that's where we have the poor mortality impact. We're trying to incentivize you as well as the consumer to do an early term conversion. Now with that, I'm going to skip this slide. We're going to talk a little bit about our GUL product. This product came out in December. It's a guaranteed no-lapse product that you can dial down to age 90 or take out to age 121, whatever you choose. The issue ages are 0 to 80, and we use age nearest birthday. Our minimum guarantee period is obviously 90. As I said, you could dial it down to 90. The minimum face amount on this policy is $25,000. When we had this product, a similar product at Genworth, we did a lot of business at that smaller face amount for older folks who could qualify for underwriting. So as an alternative to a final expense approach, they could qualify for underwriting. They get that smaller face that they need because they're older and they can't qualify for a higher face amount. We also do a lot of juvenile coverage at these smaller face amounts. So our average face amount is anywhere from $100,000 to $125,000 on this policy. It does have a surrender charge that is applicable for the first 19 years of the policy. Let's talk a little bit about the riders that are available. They're very similar to the riders that we talked about on the term product. So we do have, again, you can purchase a child term rider with this product. We have a waiver of monthly deduction rider that you can purchase. The terminal illness rider is, again, built into the product at no additional cost, and the client can get up to 75% of the policy's death benefit. This policy, just like the conversion policy, does have they call it an enhanced surrender value rider in the contract, but it's a return of premium feature that's built into the policy. You will not get it built in unless you guarantee it to at least age 100. If the client is older, let's say if they're age 70, you'll have to guarantee it for 30 years for them to get this return of premium feature built into the policy. We will be adding a chronic illness rider to this policy. It's going to be coming out looks like it's going to be middle of May that's going to be available. So if you're selling any of the product after May, you'll be able to add that chronic illness rider to the policy. I'm going to zoom in for a minute so you can see this. Hopefully it'll let me do this. Okay, yeah, I'm going to zoom in. So this here gives you a look at the return of premium feature and how it works. So if it's a face amount under $50,000, you're not going to get that return of premium feature regardless if you guarantee it to age 100. If they're younger age folks, they're not going to get it unless they go out for a longer duration. So this just gives you a feel for how the return of premium feature works. Now, I will say it's different than what we talked about just a minute ago with the conversion. Instead of 35% of the death benefit, you can get up to 40% of the death benefit. And the features are, it starts at 25% and goes all the way up to 100% return of premium. Again, this chart is available in the guide, in our product guide for this policy, so you can get a deeper look at that in the product guide. Now, from a pricing standpoint, where you want to be looking at us, we're extremely competitive if you guarantee it to age 100 or if you go shorter than that. So if you guarantee it to age 90, we're going to be very, very competitive at age 90. And I'm going to show you in a minute what that looks like on a heat map so you can get a feel for what that looks like. Pricing-wise, we're very, very competitive at $250,000 and above. And you might be scratching your head thinking, well, Carlan, you just said a minute ago your average face amount is $125, and that is true, and that is fact. But the difference is, I think a lot of people haven't been looking at this policy at the higher face amounts because they're so used to selling the lower face amounts with this particular policy. So definitely don't shy away from this policy at the higher face amounts because that's where we're going to be priced the most competitive. It's going to look more attractive if you do a level pay option or a single pay. So if you're doing a limited pay, we're not going to be as competitive on a limited pay. So let's say a 10 pay. We're not going to be as competitive on a 10 pay as we would be if you do a level pay or a single pay option. It's going to look really, really good with 1035 exchange dump-ins. Now, we do offer our smooth sailing underwriting program with this product, and I'm going to give you more information about that in just a minute, so I'll skip that for now. We'll come back to that. This policy does have an added consumer guarantee protection built into it. So if a client pays 30 days early or 30 days late, they're not going to lose the guarantee on the policy. So it's not going to jeopardize that guarantee if they're early or late on that for up to 30 days either way. They're not going to lose their guarantee. So I mentioned just a minute ago, we're going to look at some heat maps. So this gives you a feel for our pricing if you were to guarantee it for a lifetime. On the left-hand side, what you're looking at there is $250,000 policy. And on the right-hand side, you're looking at $1 million. So I'm going to zoom in a little bit so you can see a little bit better. So again, on the left-hand side, that's the $250,000. You can see that we're going to be more competitive. We're greener, obviously, on the full pay option and the single pay option. There's just not a lot of green there in that 10 pay option for us. What's something to note, I think is interesting, pricing-wise, we're going to be competitive on smokers on this policy. We are not as competitive on smokers on our term policy, but we are more competitive with smokers on our GUL. And then you can look at that $1 million bucket. We're going to get more green on the higher face amount. As you can see, it gets a little greener. And I'm going to show you another heat map. I'm going to scroll it down. So this one's going to show you if you were to dial it down to age 100, again, 250 on the left side and $1 million on the right. So I'm going to make it so you can see it a little bit. We get a little greener, as you can see. Again, we're not going to be competitive on that 10 pay bucket, but we're going to be very, very competitive on the full pay as well as the single pay. Now, this is where our true sweet spot is. So this is if you guarantee it to age 90. So this really becomes much more competitive across the board. And we actually get competitive on that 10-pay option as well with this one. You can see us at the higher ages. We're going to be more competitive on the 10-pay option where we weren't before at all. So definitely, if you want us to be the most competitive, dial it down to 90. Take a look at us there. That's going to be the sweet spot for this product. I'm not going to spend a lot of time on this. I'll scroll in a little bit so you guys can see it. But this just shows you from a pricing standpoint, if you were to run a comparison, the first option on the left side is a lifetime guarantee, and then you're going to see us at age 90. So if you do us a guarantee to lifetime guarantee, we're going to come out number 4 from a premium standpoint. You can see right there Symetra, Lincoln Financial, and Nationwide. But if you flip that and dial us to age 90, you're going to see that we're going to come out number 1 from a premium standpoint, and substantially different. It's about a $3,000 difference in the premium pricing when you do that with our product. I'm going to skip that one because I want to get into telling you about our underwriting. So as I mentioned, we have this smooth sailing underwriting program, and Marie mentioned it as well. This is our fluidless underwriting offering. It's not an accelerated program because we're using traditional underwriting with this, but there's a couple of reasons why we're doing this. So we did a lot of research before we rolled this program out in spring of last year. We wanted to find out what the field liked about other carriers' programs and what they did not like. One of the things that we heard loud and clear was that if you roll out a program like this to Carlan, to us as the agents, we want to make sure that if you tell me my client qualifies for your program, you don't come back 30 days later after I've submitted the application and say, oh no, I need a paramed and exam now. So I don't want that to happen. I don't want that to happen. The second thing that we heard from the field was, if you're going to offer a program like this, then if you come back and table rate my client, let's say that you come back as a table 2, I need to know why you're rating them as a table 2. Don't tell me it's a black box scoring or it's a credit score or something like that I can't go back and have a conversation with my client. So when we rolled out our program, we wanted to make sure we addressed those 2 concerns. And what you'll see with our program, these are the qualifications for our smooth sailing program. If the client meets these qualifications, they are locked into our program. So firstly, the ages are ages 50 to 69 for our program, which is very different from the other carriers' programs out there, because most of the other carriers focus on younger ages. We're focused on older ages, so 50 to 69. The amount that they're applying for or have in force with Pacific Life is $1 million or less. So what I mean by that, let's say you sold your client a $200,000 PL Promise term product, and then you wanted to sell them this GUL product. You could do it with smooth sailing up to $800,000, because we're going to consider that $200,000 that they already have in force as part of that $1 million total. Now, it doesn't matter what they have in force with any other carrier. It's just with Pacific Life. The third thing that they have to do is they have to have seen their doctor and had a physical that included blood work within the past 18 months. And the reason that's important is because we're not getting that paramed exam, we're going to go to that APS and get the information that we need to underwrite this client. The key with our program is any client can come into this between the ages of 50 and 69 up to $1 million in face. They could be a table 2 risk today, and they could come through the smooth sailing program, and that's fine. We don't have any class restrictions on the client coming into this program. The key is they have to have gone to their doctor and had blood work done, been poked with a needle. And the key with our program, I think it's more of a convenience program to the client. Maybe clients between the ages of 50 and 69 typically go to their doctor on a regular basis, and they don't want to have somebody come to their house and poke them with a needle or go to a Quest Diagnosis Center. They've already done that. They saw their doctor recently. They don't need to worry about that. So that's the key to this program. Now, you can do this with a long application, or you can do this with our drop ticket, whatever you prefer, but you can access our smooth sailing program either way. If you're using the drop ticket, what's going to happen is, let's say you enter your client's 55. They're applying for $500,000 in face. What's going to happen is we're automatically going to bring this question in. We're going to ask you, has your client seen their doctor in the past 18 months? And if so, do they have blood work done? If you say yes, we're automatically going to move that client into our smooth sailing process. We're going to set up a telephone interview and confirm with the client, get the information that we need, and proceed down the path. The only reason your client would ever be kicked out is if they were wrong. If they told you they saw their doctor in the past 18 months, it had actually been 24 months since they'd seen their doctor. Or they told you they'd seen their doctor in the past 18 months, and in fact they had, but they didn't get blood work done. So those are the 2 things that would kick them out, is they actually didn't meet that requirement where they saw their doctor in the past 18 months and had blood work done. Now, underwriting sweet spots, if you worked at all with Genworth in the past from a life insurance perspective, our underwriting manual is exactly the same underwriting manual that we had at Genworth. There is no difference. So I will tell you from a sweet spot perspective, build. We're extremely competitive on build up to standard. I'm 5'7". I could weigh up to 190 plus pounds and be preferred best. So if you haven't taken a look at our build chart, make sure Marie will help you with that, get you the information. It's extremely competitive build chart. Total cholesterol, 150 to 300, you can get preferred class. I will say a caveat to that. What you want to know more about with total cholesterol is what their HDL ratio looks like. So if their HDL ratio is accelerated, that's going to harm them. So 4.5 for a male is preferred best, 4 for a female. Blood pressure history, we're very competitive there, treated and untreated. Depression, they could be on 1 to 2 medications. Situational depression, we can offer preferred best on that. So definitely take a look at us on your depression cases, because we're extremely competitive there. I'll tell you the key to the depression cases are when the diagnosis is coming from their primary care physician. That's the one where you can get the preferred offers. If it's coming from a psychiatrist, that's a different situation. Usually talking clinical depression, it's very different. But if the medicine and the depression is being prescribed through their primary care physician, you can typically get a very good offer there if they're not on a lot of medications. Sleep apnea, you can get preferred best as well. The key to sleep apnea is they have to have documentation that they're doing what they need to be doing with their CPAP. So if it's well documented, they're not having any fatigue issues, you can get preferred best. Asthma, again, you can get preferred best there. I want to highlight a couple other ones. The foreign travel is a sweet spot for us. I'll say foreign nationals is not a sweet spot, but foreign travel is. And what I mean by that is The client can travel up to 4 consecutive weeks outside the United States and not have to disclose anything on the application. If they travel more than 4 consecutive weeks, then they're going to have to complete that foreign travel supplement. So what I mean by that is I can go to Timbuktu for 3 weeks and then come back to the United States and go somewhere else for 3 weeks and come back to the United States. That does not violate what I just said because it was not 4 consecutive weeks. So as long as they're traveling less than 28 consecutive days outside the country, then you're fine. We're very competitive with military, active military. We don't have any rate class restrictions. The only thing that comes into play with active military, what we're going to be looking at is what they do in the military. So if they're a pilot, that's going to come into play, or if they're a demolition expert, for example, that's going to come into play when we're underwriting them, but we're not going to hold it against them because they're active in the military. Aviation, we're extremely competitive there with private pilots. So if you've got someone that's flying less than 150 hours a year and they are instrument flight rated, they can get our preferred class, and it's very, very competitive. We're not as competitive with corporate pilots, but very competitive with private pilots. Recreational scuba diving, I skipped that one, up to 125 feet, they can qualify for preferred. The thing with that one, the key to that one is as long as it's not like wreck diving or cave diving, that's considered different. All of these pieces, all of these sweet spot pieces are available in a brochure that's called our Underwriting Sweet Spot brochure. They'll give you more information on each one of these sweet spots, and Marie can get that to you as well. So I know I gave you a lot of information. We talked about the financial strength, the recognition that we have with Pacific Life. We've talked about our innovative underwriting programs. We've got a lot of things going on with underwriting, our competitive term products. You know, we just expanded into the GUL market space in December. We're going to be adding that chronic illness rider to the product in May. And then we're going to be looking at our next offering. What's going to be our next product? We're talking about things like a term product with an accelerated benefit rider. So different things to come and more products to come. And we're very focused on staying best in class with our service to make sure that policy gets in the door and gets out as quickly as possible. So we talked about the different things that we have available from a marketing standpoint. We have a lot of brochures, but we have some consumer pieces. If you're interested in that, Marie can get that to you as well. And this is just a look at our sales team. I am, my boss is on the left side, Brian Bulakaitis, and then we've got Ivy Knoll. She's located in Lynchburg, Virginia. She's our internal wholesaler. She's wonderful. So if you need illustration support or marketing support, she can help you with that. Mr. Rob Bish is in the middle. He covers the Northeast. I'm right below Rob. I cover the Southeast, and then there's Michelle Casoy on the end. She covers the West Coast. So, Marie, I'm going to hand it back to you to see if you want to take time for any questions.
All right. Let me see if I can open it up. Yep. I have opened it up, so if anybody has any questions, now's the time to ask. And if you have something that you think of later, feel free to reach out to me, and I can get in touch with Carlan or whoever's needed. All right. Well, then with that, I will thank you, Carlan, for going through this. And if anybody has any questions, again, feel free to reach out to me at 813-875-6331. Thank you for your time, and we'll talk to you soon.
Bye-bye.